The United States' decision to sharply raise tariffs on Indian goods landed like a storm in markets that had grown comfortable with a steady, predictable trade relationship. For decades, trade between New Delhi and Washington had been a story of increasing interdependence. Indian exporters found lucrative demand in American retail chains. U.S. buyers relied on Indian suppliers for cost-competitive inputs, and whole towns and districts in India developed around industries built on those export linkages. Overnight, that landscape looks different. The tariffs announced in 2025, which, depending on the tranche, add up to very large increases for many product lines, immediately changed the math for competitiveness. These are not small technical barriers. They are blunt instruments that raise prices, slow orders, and force businesses to make quick choices about survival, payout, and markets. The U.S. action was framed in Washington as a response to a set of geopolitical and commercial grievances. Whatever the political calculus, the economic reality for many Indian firms is the same. Margins are squeezed, and some buyers are likely to walk away rather than absorb the higher price tags. To understand the scale of the shock, it helps to look at the numbers. In 2024-25, India's merchandise exports to the United States were valued at approximately $86.5 billion. That figure is not just a macroeconomic statistic. It is a measure of livelihoods, enterprise, and investment that are now exposed to new policy uncertainty. When the U.S. announces a tariff increase that effectively raises duties on many products by very large percentages, the real-world consequences cascade. Retailers reassess sourcing contracts, importers pass on costs to consumers, and exporters face either the loss of orders or the choice to cut margins until better markets are found. This is the kind of shock that turns boardroom debates into bread-and-butter dramas overnight. The most visible early impacts fall on sectors that are both labor-intensive and geographically concentrated. Gems and jewelry, textiles and apparel, leather goods, certain chemicals, seafood like shrimp, and footwear are repeatedly named by industry observers as especially vulnerable. These industries are not only important for export revenues, they are major employers in clusters across India, towns and districts where the textile mill, the gem cutting workshop, or the tannery are the nucleus of local livelihoods. When tariffs make those products substantially more expensive in a core market, demand shifts quickly to alternative suppliers or alternative products. That shift is painful. Layoffs, canceled purchase orders, and the erosion of long-term buyer relationships that take years for exporters to build. In some cases, exporters can temporarily absorb costs, but many are already operating on thin margins and cannot do so for long. Early estimates of the scale of disruption vary, but even conservative models show significant downside risk. Think tanks and trade analysts have projected that exports to the U.S. could shrink materially if tariffs persist or escalate, some models showing falls measured in the tens of billions of dollars the following fiscal year. That is not only a number on a spreadsheet, it's a map of towns where orders vanish, of supply chains unraveling mid-contract, and of businesses that must suddenly decide whether to downsize, pivot, or seek new markets on extremely short notice. The authorities in New Delhi are acutely aware of these risks, and that is shaping a rapid set of policy responses. Policy reaction must be multi-layered because the problem works at multiple speeds. There is the immediate shock, canceled orders, cash flow stress, supplier payment risk. There is the medium-term problem of rerouting demand and adjusting supply chains. And there is the long-run structural challenge of reducing vulnerability to unilateral policy shocks from any single partner. The immediate measures are, by necessity, pragmatic and time-limited. Emergency liquidity and targeted fiscal relief are the first line of defense. For many exporters, the immediate pain point is working capital. They have bought raw materials, run production, and rely on incoming orders to pay wages and service loans. If those orders are delayed or reduced, payroll and loan servicing become impossible without help. That is where subsidized credit lines, emergency grants for the most affected micro, small, and medium enterprises, and fast-tracked refunds of export credits and tax rebates can prevent a cascade of defaults. These are not elegant solutions, they are triage. But triage can save lives, or in this case, save firms long enough to pivot. The quick deployment of such measures also signals to markets and to foreign buyers that India intends to contain the damage and preserve its capacity as a supplier. Those signals matter to foreign buyers who may be tempted to write off Indian suppliers as high risk and permanently switch to other countries. Simultaneously, the government must mobilize trade diplomacy in a way that would have been unthinkable a few years ago. Trade promotion offices, embassies, and consulates must be reactivated with a singular focus: find buyers fast. Virtual trade missions, digital catalogs, and expedited certification processes can bridge some of the gap caused by lost U.S. There is a practical playbook here that can be dialed up quickly. Identify overlapping products in demand in the EU, ASEAN, Africa, and Latin America. Match Indian exporters with buyers via trade fairs and bilateral matchmaking, and offer temporary logistics support, for example, subsidized shipping or insurance to ease the transition into new markets. For higher value differentiated products, Indian exporters should emphasize quality, compliance, and traceability to win over buyers who are willing to pay slightly higher prices for reliability and brand assurance. This is not a path that moves all volumes immediately, but it is an essential part of stabilizing the situation within weeks and months. There is also a role for targeted trade facilitation. Lowering import duties on critical inputs for affected sectors can reduce production costs, enabling exporters to be more competitive in non-U.S. markets. Streamlining port paperwork and offering temporary duty drawback enhancements can speed up cash conversion cycles. The Export-Import Bank and commercial insurers can provide bridging finance and credit insurance so firms can accept new orders without the fear of payment defaults. These actions collectively buy precious time and preserve productive capacity. But emergency relief and market rerouting alone are not enough. The political economy of tariffs is such that durable solutions require diplomacy and legal clarity. India must engage Washington on multiple channels simultaneously. Officially, through trade negotiators and the Commerce Ministry, India should press the case that broad-based tariffs violate principles of fair trade and harm consumers and businesses on both sides. Technically, the case might be framed in legal terms under WTO disciplines. Even if a WTO process is slow, its initiation is an important signal that India is prepared to use rules-based avenues to seek redress. At the same time, India must use political channels inside the United States. That means engaging with U.S. senators, members of Congress, state governors, and industry groups who depend directly on Indian imports. These actors are often the effective veto on punitive policy measures because they themselves bear the political cost of disrupted supply chains. The strategy of pressing domestic U.S. constituencies is important because U.S. tariff decisions are rarely insulated from internal American politics. If targeted lobbying can show that tariffs raise costs for U.S. producers, retailers, and consumers, and that those costs are politically salient in key states, it creates pressure for Washington to soften or withdraw the measures. It is difficult politics, but it is also the kind of engagement that has historically produced refinements to punitive trade action. New Delhi, therefore, should not rely only on intergovernmental pressure, but should also facilitate and amplify the voice of affected American businesses that will benefit from continued trade with India. If diplomatic engagement fails or is too slow, India must be ready with a credible, legally defensible set of retaliatory options, but retaliation must be calibrated.
The reflex to mirror tariffs immediately is understandable, but mirror measures risk escalating into a tit-for-tat spiral that harms both sides and global supply chains. Instead, India should compile a menu of potential countermeasures that are targeted, time-bound, and chosen for strategic leverage. For example, selectively applying duties or restrictions on products that are politically salient in specific U.S. districts may create domestic pressure on American lawmakers. Whatever measures India chooses must be defensible under WTO law when possible. Regimes that are transparently retaliatory but legally grounded are stronger bargaining chips in negotiation. There is a broader economic lesson embedded in this crisis. Diversification is not optional. Dependence on a single market, even one as large and stable as the United States, is a vulnerability. India's long-term strategy must therefore accelerate efforts that were already underway, expand exports to high-growth regions, negotiate and implement ambitious regional trade agreements, and selectively liberalize sectors where export potential is high but current barriers exist. It must also deepen sector-specific strategies to move up the value chain. The more India can convert low-margin commodity exports into higher-value branded goods through quality upgrades, design, and intellectual property-led differentiation, the less raw tariff shocks will matter. Buyers are more likely to tolerate price shocks for unique high-quality items than for fungible commodity-like products. Within India, this moment should be the spur to improve fundamentals that affect export competitiveness across cycles. Logistics costs remain a persistent drag on Indian exporters. Investing in port modernization, hinterland connectivity, and efficient customs processes will reduce the cost penalty Indian firms face. Labor reforms that increase productivity while protecting worker welfare can help, as can targeted skill development programs that enable clusters to move into higher value activities. Regulatory predictability and faster dispute resolution mechanisms also increase buyer confidence. All of these domestic policies reduce the economy's sensitivity to shocks and make it more attractive for foreign investors considering onshoring or nearshoring production. Investor psychology also matters. When tariffs hit, foreign buyers begin to question supply chain reliability. India must therefore signal stability and responsiveness. Quick deployment of relief measures, visible trade diplomacy, and clear timelines for medium-term reform will reassure investors and trading partners that India is both proactive and resilient. The government's communication strategy must therefore be as operationally important as its policy actions. Calm, transparent messaging avoids panic and preserves relationships. Finally, India must frame its response not just as defensive but as an opportunity to shape a new era of trade relations. If handled deftly, the response can elevate India's global trade diplomacy, deepen ties with new partners, and accelerate economic reforms that raise productivity over the long term. The tariffs are a shock, yes, but shocks also catalyze change. The question is whether India's policymakers and private sector view this as a moment to retrench or as a moment to accelerate a higher ambition strategy. The latter path is harder, but it will pay dividends not only in lost export recovery, but in the broader story of India's economic emergence. The second half of a sustained strategic response requires diplomatic imagination, legal precision, and a long-term commitment to structural change. Diplomacy will have to be multi-vector, operating in Washington, in multilateral fora like the WTO, and in regional or plurilateral coalitions where India's voice carries weight. The WTO, imperfect and slow as it may be, remains a crucial instrument. Initiating or pursuing dispute settlement procedures accomplishes several objectives simultaneously. It formalizes India's objections in a legal forum. It signals to global markets that India is not conceding to unilateralism, and it creates time and space for parallel negotiations. Even if the WTO process takes months or years, the act of filing can change the political dynamics. Other countries watching Washington's approach will note whether the U.S. stance withstands legal scrutiny. If it does not, it becomes diplomatically costly for policymakers in the U.S. to persist with aggressive measures. Using the WTO is not a panacea, but it is an indispensable part of a rules-based strategy. Reuters World Trade Organization. In Washington, India must calibrate a message that is simultaneously firm and pragmatic. Trade negotiations are seldom resolved purely on the basis of legal principle. They are solved where political constituencies intersect. India will win more if it can show Americans who would be hurt by tariffs, American retailers, manufacturers and workers dependent on Indian inputs, that their economic interest aligns with continued trade. This is a time for targeted outreach, business-to-business engagement, state-level diplomacy, and the cultivation of bipartisan political support among U.S. legislators who have strong ties to affected industries. Such engagement is particularly effective where U.S. industries have invested in India or rely on Indian inputs in their supply chains. Public-private partnerships in negotiating relief or phased adjustments can produce outcomes that are more durable and less politically volatile than headline-grabbing measures initiated without stakeholder buy-in. The legal and technical team that prepares India's case must be highly granular. A WTO complaint must demonstrate how a tariff measure violates specific treaty obligations, which requires deep product-level analysis and trade law expertise. Simultaneously, India should prepare a clear and prioritized menu of potential retaliatory measures that are both legally defensible and politically targeted. The list should be calibrated to maximize bargaining value while minimizing harm to global supply chains. That means identifying U.S. exports that are politically sensitive in key districts and that do not create structural damage to India's own economy when used as leverage. For example, aligning potential countermeasures with sectors where U.S. domestic politics creates vulnerability, agriculture, certain industrial components, or politically visible consumer goods could increase the pressure on U.S. decision-makers to negotiate. India should also accelerate strategic trade partnerships that offer both market access and supply chain resilience. Deepening ties with the European Union, ASEAN countries, the UK, Canada, Japan, and Australia will not be a single policy move but a strategic arc across many agreements and initiatives. India's participation in broader regional value chains, particularly in Asia and Africa, can be materially increased with targeted investment, trade facilitation, and regulatory harmonization. For example, doubling down on the Quad's economic working groups, accelerating bilateral FTAs where politically feasible, and exploring sector-specific trade agreements can open alternative channels for Indian goods. The goal is not to replicate the U.S. market overnight, but to create multiple robust outlets for Indian manufacturers and exporters so that shocks in any one market have limited systemic impact. A parallel economic strategy involves industrial policy that makes India indispensable in global supply chains. This is not simply the old import substitution model, it is a modern outward-facing industrial strategy. The government's production-linked incentive programs are a start. What matters next is the intensity and quality of integration. India must target sectors where the world is expanding: renewable energy components, solar modules, wind turbine parts, electric vehicle battery components, pharmaceuticals, medical devices, electronics and semiconductors, in partnership, and high-quality processed foods. The aim is to move Indian exports into stages of production where scale and technical capability create stickiness for buyers. Global manufacturers do not easily substitute national suppliers when those suppliers occupy critical steps in a complex, capital-intensive chain. Policy levers available domestically must be used judiciously and at scale. Infrastructure investments, world-class ports, efficient customs systems, and reliable domestic logistics reduce the hidden costs that make Indian products less competitive. Skills and productivity investments increase the added value that firms can deliver. Strengthening standards, traceability, and quality certification helps Indian producers access premium markets that are less price-sensitive. All these measures are long-term bets, but they compound. Productivity improvements make firms more able to weather tariff shocks. Better infrastructure shortens delivery times and reduces costs, and higher standards unlock markets where buyers are willing to pay a premium for reliability and compliance. Finance and risk mitigation deserve a strategic upgrade. Export credit agencies must be ready to underwrite large flows and to offer political risk insurance, while commercial banks should be encouraged to lengthen tenor and restructure loans for exporters under stress. Special credit windows, loan moratoria, or guarantee schemes can prevent a cascade of insolvencies in the critical months after tariffs land. Policymakers should also consider instruments that incentivize buyers to stick with Indian suppliers, for example, export credit lines that extend to buyers in alternate markets, or co-financing arrangements that reduce the immediate cash flow burden of shifting sourcing arrangements. On the trade politics front, communication is as critical as policy. India's message must be twofold. Domestically, reassure citizens and firms that the government is deploying every tool to protect jobs, incomes, and enterprise. Internationally, present a reasoned case for the resumption of normal trade relations grounded in mutual benefit. Narratives matter. If India can show that its trade policies are part of a stable, predictable framework that supports global value chains, it will be easier to rebuild confidence among buyers and investors. There is also a broader strategic dimension to consider. Trade policy does not exist in a vacuum. It is part of a larger geopolitical relationship that includes defense, technology cooperation, and people-to-people ties. India's approach to the tariff shock should therefore be mindful of the wider strategic partnership while defending core economic interests. This requires a nuanced diplomacy that separates areas of unavoidable friction from areas where cooperation can continue or be deepened. In practice, it means continuing to work on defense and strategic dialogues even while pressing trade grievances, because transactional leverage on trade can sometimes be offset by cooperation in other areas, and because preserving channels of strategic trust prevents crises from boiling over. The private sector's role in this phase is massive. Indian industry associations, exporters' councils, and larger multinational partners must be treated as co-strategists, not just beneficiaries. Coordinated strategies that involve data sharing, market intelligence, pooled promotion efforts, and joint financing mechanisms will produce stronger outcomes than fragmented pushover responses. Export clusters should be supported with cluster-specific survival and upgrade plans, not one-size-fits-all relief. For instance, a diamond-cutting district in Surat faces different market dynamics than a software export hub in Bangalore. Policy responses should be calibrated accordingly. Scenario planning is another underrated tool. The government and industry should develop multiple response scenarios, from a best case where tariffs are rolled back quickly to a prolonged scenario where trade patterns shift permanently. Each scenario should have clear timelines, action items, and thresholds for escalation or de-escalation. Having these playbooks ready prevents panic and enables rapid, coherent action when circumstances evolve. There is also an opportunity in the crisis for creative economic diplomacy in the global south. India can use this moment to strengthen trade relations with African economies, with Latin America, and within South Asia regions where there is unmet demand for manufactured goods, and where India's proximity and growth can be a comparative advantage. Coordinated offers of technical assistance, capacity building in standards and quality, and targeted market access arrangements can create durable new outlets for Indian exports. That strategy aligns with India's broader geopolitical posture, building South-South partnerships that are mutually beneficial and less dependent on single vulnerable markets. Finally, the narrative India tells about itself as a trading partner needs an upgrade. India has to be perceived as reliable, high quality, and forward-looking. That requires a steady program of reforms that are visible to global buyers, faster approvals, transparent regulatory processes, predictable taxation, and demonstrable improvements in logistics and contract enforcement. Over time, these changes create a reputation premium that can blunt the effect of short-term tariff shocks. If India plays its cards well, this tariff episode can be the inflection point that accelerates structural reform, diversifies markets, and deepens trade diplomacy. If it is mishandled, the short-term pain will linger, and the political fallout will be deep. The stakes are high not only because of lost export revenues, but because trade is a vector for technology, standards, and industrial learning. India must therefore treat this moment as both a defensive challenge and an offensive opportunity. Defend the immediate economic base with quick relief and smart legal action, and attack the longer-term vulnerability with policy reforms, diversification, and a diplomatic campaign that transforms shock into strategic advantage. In practical checklist terms, the next 90 to 1 constituencies, WTO preparations, and aggressive alternative market development. The next 6 to 18 months should prioritize industrial upgrading, targeted trade agreements, infrastructure pushes, and financial instruments that de-risk exports. Over the following years, India should consolidate gains by embedding itself deeper in critical global supply chains and by becoming a preferred partner in future-facing industries. Tariffs are a test of resilience and statecraft. How India responds will determine whether this moment is a setback or a catalyst. The right combination of fast relief, savvy diplomacy, legal firmness, and sustained reform can not only blunt the immediate crisis, but also rewrite the architecture of India's global economic relationships. That outcome is not automatic. It depends on strategy, speed, and political will. But if New Delhi and India's private sector move decisively, with vision that extends beyond the next quarter, they can turn a jolt into a jump, and the next decade of Indian trade may look very different for the better.